Welcome to this American Northwest Magazine presentation. Please like, subscribe, share, click on the notification bell, and we welcome your comments. In the world of Bitcoin, where change is the only constant, recent months have shown a remarkable transformation. With the end of what many called the crypto winter, Bitcoin has surged, fueled by optimism within the cryptocurrency market. As of this making of this video, Bitcoin has climbed 7% to approximately $65,000 over the past 24 hours. Reflecting on past market impacts, we recall when Jamie Dimon of JP Morgan threatened termination for any employee trading Bitcoin, which once led to a significant drop in its value. Yet behind the scenes, purchases by major financial players like JP Morgan and Morgan Stanley have unfolded, underscoring a significant shift in institutional attitudes towards Bitcoin. Yet the ability of these major players to manipulate price by lying and misleading, causing the price to dump while secretly purchasing after the price dumps, should be illegal. But it is not. Perhaps we should be emailing the White House and Congress to bring the culprits to justice and make this an illegal act. The current climate suggests it's riskier to be out of the market than in it. We are possibly witnessing the start of a substantial bull run, with expert analysts predicting Bitcoin could reach as high as $100,000 per unit by year's end. This echoes parallels with the gold ETF, which also saw significant growth after its initial introduction. Recent market trends show significant investments from tech giants and adoption in mainstream payment platforms, further solidifying Bitcoin's position in both financial and retail landscapes. Predictions from leading economists suggest continued upward trajectories, influenced by international monetary policies and growing acceptance of digital currencies as part of diversified investment portfolios. New data from a consortium of economic researchers highlights a trend of increasing volumes and an expanding user base, suggesting a broader acceptance across demographic boundaries. Update from the Federal Reserve's recent statements by Chairman Powell and other global economic indicators suggest a heightened interest in digital currencies as a hedge against traditional financial volatility. Thank you to Business Insider for contributing to today's insights. Remember, knowledge is power. And in the world of Bitcoin, that power could translate into substantial financial returns. Delving deeper into the Bitcoin ecosystem, it's crucial to spotlight the unsung heroes of the cryptocurrency world, the Bitcoin miners. These individuals and companies are the backbone of the Bitcoin network, providing the computational power required to process transactions and secure the blockchain. But what does mining involve, and how does it influence Bitcoin's price? Mining Bitcoin is an energy-intensive process where miners solve complex mathematical problems to validate transactions and add new blocks to the blockchain. In return, miners are rewarded with newly minted Bitcoins. This process not only introduces new Bitcoin into circulation, but also fortifies the security and integrity of the entire system. However, the profitability of Bitcoin mining is heavily dependent on the price of Bitcoin itself. As the price of Bitcoin increases, so does the revenue for miners, making their operations more sustainable. Conversely, when prices drop, miners can struggle to cover operational costs such as electricity and hardware maintenance, leading to a potential decrease in mining activity. This dynamic creates a fascinating feedback loop. For miners to continue securing the network, the price of Bitcoin needs to be sufficiently high to cover their substantial energy and hardware expenses. Moreover, the impact of Bitcoin mining on its price isn't just about profitability, it's also about supply and demand. The rate at which new Bitcoins are generated and enter the market is predetermined and decreases over time through events known as halvings, which reduce the mining reward by half approximately every 4 years. These halvings can lead to tighter supply and potentially price increases if demand remains strong. Recent advancements in mining technology and shifts towards renewable energy sources are also crucial factors. As mining becomes more efficient and environmentally friendly, it could lead to broader acceptance and stability within the market, influencing Bitcoin's price positively. In essence, Bitcoin miners play a pivotal role in the sustainability and valuation of Bitcoin. Their ability to adapt to market conditions and technological advancements continues to be essential for the cryptocurrency's stability and growth. As we monitor Bitcoin's market trajectory, the health and evolution of mining operations will remain a critical area of focus. Every 4 years, the Bitcoin community experiences a pivotal event known as halving, a deliberate mechanism embedded in the heart of Bitcoin's protocol to control inflation and extend its issuance over a longer period. This event cuts the reward that miners receive for adding new blocks to the blockchain by half, hence the term halving. Let's delve into how this significant event influences the supply and price dynamics of Bitcoin and its broader impact on the miners and the market. As we approach a halving, the rate at which new Bitcoins are created decreases dramatically. Originally, the reward was 50 Bitcoins per block. Following the first halving in 2012, it dropped to 25, then to 12.5 in 2016, and most recently to 6.25 in 2020. This reduction in block reward means that fewer new Bitcoins are generated, which can lead to a decrease in supply. Assuming demand remains constant or increases, the reduced flow of new Bitcoins can lead to upward pressure on its price. The anticipation of this price increase often leads to a surge in market activity before the halving occurs. Investors and speculators may buy up Bitcoins, predicting that the price will rise post-halving, which can create a self-fulfilling prophecy of increasing prices. However, it's crucial to understand that these are speculative markets, and while historical trends can provide insights, they do not guarantee future outcomes. For miners, the halving event is a double-edged sword. The reduction in block rewards means that their potential earnings are halved, significantly impacting their profitability. This is especially challenging for smaller mining operations that might not have the capital to sustain through periods of lower profitability. Post-halving, the efficiency of mining technology and operational cost management become even more critical. Miners may need to upgrade their hardware to more energy-efficient models or relocate to regions with cheaper electricity to maintain their margins. Moreover, halvings contribute to the long-term scarcity of Bitcoin, mimicking the extraction of a precious resource like gold. This artificial scarcity is an integral part of what attracts many investors to Bitcoin, viewing it as digital gold that can act as a hedge against inflation and currency devaluation. In conclusion, Bitcoin halvings reshape the landscape of the cryptocurrency market, influencing everything from the miners' strategies to the speculative behavior of investors. By understanding these dynamics, participants in the Bitcoin ecosystem can better navigate the complex interplay of supply and demand that halvings intensify. As we explore the fascinating world of Bitcoin, it's crucial to understand the cyclical nature of its market. Every 4 years, aligned with the halving events we discussed earlier, Bitcoin seems to undergo significant bull and bear phases. These cycles are characterized by periods of rapid price increases followed by corrections or downturns. Let's break down these phases and use historical data to forecast potential future trends. Firstly, the bull market phase typically starts about a year before a halving and can continue for a year afterward. This phase is marked by increasing investor interest, media hype, and a general FOMO, fear of missing out, as prices climb. For instance, after the 2012 halving, Bitcoin saw an unprecedented bull run, peaking in 2013. Similarly, the post-2016 halving period witnessed a massive surge, with Bitcoin reaching its then all-time high in December 2017. Following each bull run, the market tends to enter a bear phase. During this time, prices correct sharply, often wiping out a significant portion of the gains from the bull market. This phase can be driven by various factors, including regulatory news, market fatigue, and a shift in investor sentiment. The bear market following the 2017 peak is a prime example, where Bitcoin lost over 80% of its value by the end of 2018. Understanding these patterns helps investors and enthusiasts make more informed decisions. By examining the timing of halvings and the subsequent market reactions, we can attempt to predict future trends. If history is any guide, the next bull market might be initiated a year before the upcoming halving in 2024, potentially reaching new heights in 2025. However, it's essential to approach these predictions with caution. The cryptocurrency market is highly volatile and influenced by numerous external factors like technological advancements, geopolitical events, and changes in the regulatory landscape. Therefore, while historical patterns provide valuable insights, they are not foolproof predictors of future behavior. In conclusion, recognizing the cyclical nature of Bitcoin's market phases, understanding when bull runs might start, peak, and eventually lead into bear markets, can significantly enhance strategic planning and risk management in cryptocurrency investments. As we look towards the future, staying informed and agile will be key in navigating the ever-evolving landscape of Bitcoin. As we delve deeper into Bitcoin's market trends, it's essential to harness expert analysis and robust statistical models to forecast the potential highs and lows in the coming years. Given Bitcoin's history, experts suggest that the cryptocurrency market will continue to experience significant volatility, but also immense growth opportunities. Firstly, let's examine the predictions for the next bull run. Experts, using data-driven models, forecast that Bitcoin could experience a substantial increase in value leading up to and following the 2024 halving. Statistical models based on past performance suggest a potential peak that could surpass previous all-time highs, possibly reaching upwards of $100,000. This projection considers factors like increasing institutional investment, advancements in blockchain technology, and broader acceptance of Bitcoin as a payment method. However, with high peaks come deep troughs. Post-peak, our models predict a correction phase that could see values drop significantly, potentially by 50% or more, mirroring past market corrections. This expected downturn would be a result of profit-taking, market saturation, and potential regulatory challenges. Experts recommend that investors prepare for this volatility by considering diversified investment strategies and keeping abreast of market trends and regulatory changes. Moreover, beyond the immediate cycles tied to halving events, long-term forecasts suggest a gradual yet steady increase in Bitcoin's baseline value. This growth is supported by increasing global digitalization, the rise of decentralized finance, DeFi, and the ongoing shift towards digital currencies by governments and corporations. In conclusion, while the potential for high returns is significant, the path is fraught with risks. Savvy investors should heed the lessons of past cycles, adopting a balanced approach to risk management and remaining vigilant to the fast-evolving market dynamics. As always, staying informed through credible sources and continuous learning will be crucial in navigating the future of Bitcoin investments.